This is the All-Star Charts podcast with JC Peretz. Hey guys, the bond market just caused an estimated $4 to $7 trillion in losses in a very short period of time. Who better to have a conversation with than JC's favorite bond trader, Larry McDonald. Larry is a former bond trader at Lehman Brothers and author of one of JC's favorite books, Colossal Failure of Common Sense. We encourage you to pick up a copy after you give this episode a listen. This conversation is timely for sure, but also you know how much JC enjoys talking about the bond market. He can't get enough of it. Hope you enjoy.
I asked you to come in here and, I want to talk about bonds. You're the bond guy. You're my bond guy anyway. I don't want to talk about politics. I don't want to talk about the economy. Those things make my brain hurt. We talk to investors all the time. We like to focus on price. I know you do a nice job of bringing a lot of things together. Talk to me about bonds, man. Credit spreads at the narrowest levels we've seen in a year. Rates all over the world spiking. Bonds getting destroyed. Bonds are the war. Treasuries are the worst trade. They're worse than gold, right? And Here we are at the end of February 2021. What's up?
Well, today in the chat, it's really the last couple of days, it's gone more global. So we have a live Bloomberg chat with about 600 institutional investors, and a number of people have been citing this. Like, what happens is that something like this develops, and then the narrative starts to change a little bit. So in terms of duration capital losses on the planet Earth this year, you're now looking at, some people are saying $5 to $6 trillion of losses, because you had about 110 trillion of bonds that were below 1 3/4% in yield, and a lot of that was negative, and a lot of that was like less than 1%. And so the backup is really starting to create a problem for, what we call duration losses. All that means is when rates are low for so long, people reach out on the yield curve for more yield, and that's where the pain is. There's a government bond that matures in 2050 that traded this morning at 77 cents on the dollar. Right? So it's almost a 25% off sale for some of these bonds.
And at what point does that unwind in the bond market and all of those losses start to trickle into other asset classes where other assets become a source of funds? Like, are we really far from that? Are you seeing a little bit of that?
Okay, so there's two. That's absolutely perfect question, because that's what people are saying in the chat this morning. So we've had like a debate between all the institutions, and 2 or 3 people have brought that up. There's 2 things. Number one, the clients in the chat, and I'm in this camp. They think that the Fed has so much invested in this recovery, and they've done such a decent job up to this point that. And they remember 2018, how quickly they were just thoroughly embarrassed. I mean, it was just pathetic. And they didn't appreciate exactly what you talked about, that move up in rates and what it could do to financial conditions. And we went we went like, in 2-3 months, we went from roaring economy to almost a recession, because there's just an extra, trillions and trillions of more debt on Earth today than there was, say, 10 years ago. So when 100 basis point move up today is like it's like a 5% move up in rates 10, 15 years ago. You have to understand that people are like, oh, geez, we're only up, 50 basis points. That's just not the case. There's trillions and trillions and trillions more debt on the planet Earth that's below 1 3/4. So people think, and I agree, that the Fed's going to have to step in on yield curve control around 1.5 to 1 3/4% on 10s. But to get more specific to your question, in high yield and investment grade bonds, we haven't seen we've seen the last day or so, we've seen some selling, but we haven't seen big losses. And so if you look at the Goldman Financial Conditions Index, that is one of the key bellwethers for like what's going to push the Fed into yield curve control in my mind. And that has it's reversed. I mean, it's off the lows, but it's not in danger territory. But today, what's interesting on Bloomberg, there's a Bloomberg terminal and there's the top stories. And I noticed today for the first time in a long, long time, there was a top story about convexity hedging in the mortgage market. And that's, they're basically talking about 7 trillion of mortgages that have recently been reset, or the mortgage portfolios, a number of them have been reset at these lower rates. So then when rates back up, the banks have to actually have to sell mortgages to hedge that book, and that kind of feeds on itself. So that's probably the biggest danger, is that this move up, gets out of control and the Fed has to step in.
You touched on high yield, and that's been the leader there, right? It's been high yield rushing the treasuries, right? I mean, just the spreads there, I mean, they're out of control, which that leads me to believe that we should be in an environment where stocks are doing well. And as it turns out, stocks have been doing very well, with high yield being the leader and treasuries being at the bottom of the barrel in the bond market. And that hasn't changed. But we should be following that very closely, because you're going to see it there. Like, if there's real trouble, if there's real systemic risk, and the things that we're talking about, the money flowing out of the bond market and getting crushed, trickling into other asset classes, you're going to see it in those spreads between high yields, right?
Yes, and high yields, I mean, some weakness today, but you're still, like you said, we're really on multi-year tights. We're a little off of that the last 2 days, but it's no high yield is looking at one thing. It's looking at the $1.9 trillion fiscal plan. Remember, a lot of that money's into the high yield's a little bit like the KRE or the IWM. So KRE, which is the regional banks in the United States, IWM, small caps, and then high yield. Basically, that group loves fiscal policy, because all that juice that's coming out of this $1.9 trillion deal, plus a potential deal and another deal in the backdrop. So that's what's the high yield market's really looking forward at, that fiscal policy, and they know that a lot of that's going to be spent in the United States, and so that's really keeping high yield contained relative to what's happening in treasuries, because high yield's just looking at all that fiscal policy coming their way.
When it comes to the banks, I'm curious your thoughts. Is it the 2s, 10s, or is it the 3-month 10s? Like, what's that curve that impacts the banks the most?
Well, I think for some of the broker dealers, like the Schwabs of the world, the front end steepening makes their profits go up a lot, because a lot of these banks will hold lots of, especially like Schwab and Ameritrade. I don't really call them banks, but they keep a ton of money in the front end of the yield curve. So any steepening there is extremely beneficial to the Schwabs of the world. And then when you see that steepening, as we saw like 2017, 18 in the front end, my God, and you look at some Ameritrade, Schwab, those stocks were up 100%. But globally, I think the bigger picture here, JC, is that, and you've been pointing this out, this is a global, the Fed has realized that every single time they've tried to execute monetary policy and like kind of unwind or take down their book, they've blown up the global economy. And so they understand that the dollar's the problem. So the global stocks know that. And as you've been pointing out, these global banks, like the Japanese banks, MUFG, Mitsubishi, we have a position that in our portfolio, and that bank is trading at 0.5 times book, 0.4 times book. But if you have a global steepening of the yield curve, which we're starting to get right now, just look at Japanese yields, look at German yields today. German yields today made a big move. One of the, I guess, I mean, they're still negative 24 bips, but the highest level in multi-months. So as that global yield curve steepening, and that's a big move today, you want to be in these global banks, and I like the Japanese banks because that's the ultimate reflation steepener.
Not to mention, you take a look at that Nikkei, 30-year highs, baby. How about that, Larry?
Yeah, exactly. The money is, there's been the last 10 years, everybody's been hiding out in the United States because we've had tea parties, Brexits, trade wars. I mean, think of it, the Brexit. You had Tea Party, then you had the taper tantrum, then you had Brexit, then that was 2 years of real stress, and then you had trade war, and then COVID. So all that just drove trillions and trillions of dollars into the United States. And now we're coming to the next decade. Looking forward, there's going to be a lot more money made outside the U.S. than inside. And so, yeah, Nikkei, Japanese banks. I love the EWU. That portfolio in the EWU, it says it's a UK ETF. But if you just look at the portfolio, it's more of a global ETF of, you got your Vodafones in there, you've got your Glencore, your commodities, your BP, Rio Tinto. It's just a dream portfolio. You've got financials, HSBC. So it's got financials and commodities, which is made that is made for a global steepening. And I think you put out some great charts recently of showing kind of the rotation into these global stocks. But what I noticed this morning is that EWU versus the S&P, that has broken a multi-year channel. So that'd be great for you to share with your clients.
Well, I mean, you talk about natural resources and all these commodities, and you talk about financials. I mean, that's got Canada written all over it, doesn't it?
Yeah, I tell you, Canada. I'm playing Canada in some different spots, some of the uranium names and some of the silver names, but I haven't looked at the whole basket. But you're right. That the Canadian ETF is loaded with oil companies, loaded with banks.
60% of Canada, roughly, is financials and natural resources.
Yeah.
Not including industrials. If you add industrials, now I think you're pushing 70%. Like that's pretty, which is why they've been such underperformers for so long, because they're full of banks and natural resources, right?
Exactly. And then now, I think you want to think of 2010 to 2020 and that kind of deflation decade. And now you want to think 2020, 2030, more of a reflation, inflation, fiscal policy. The mindset around fiscal policy has just totally changed, and governments are really kind of want to spend their way out of this COVID mess.
Larry, I don't want your head to get too big here, but you were on the podcast basically 1 year ago and absolutely nailed the bond trade. Nailed it. I don't know if you remember, go back, whip out the tape. Man, you said it was late February. We were buying bonds at the time. You were like, yeah, JC, we're buying bonds. You got to buy bonds for now. And then you're like, and then bonds are going to get destroyed. I think those are your exact words, especially towards the end of the year. And as it turns out, that's exactly what happened. So kudos to you,
Thank you.
Larry McDonald. So since you're so smart and all that, what's the bond market going to do next?
Well, I got to say, there's no I in team, and I work with a great group of clients and friends, and it's really about our live Bloomberg chat. It's really about having those clients in 26 countries and just sharing ideas. And a number of people last February, March, April were really starting to look at this reflation trade, and the problem was, for the psychology of the street, it was just the people were just so wedded to the previous 10-year portfolio that it was very tough to get the entire investment community globally to embrace reflation, higher yields, steeper yield curves, and so that's kind of where I kind of try to talk to people like you, talk to clients, and then try to triangulate information. And that really comes from the book. Our book is now in 12 languages. It's a Colossal Failure of Common Sense, one of the global bestseller. And when the best part of writing the book is you may actually make more money on the speaking tour than you do writing the book. And so we did 120 speeches in 16 countries over the last decade. And we met a lot of incredibly talented portfolio managers in Europe, in Asia, in Latin America, and obviously all around the United States, Canada. We've been up to Canada probably 20 times. And so that's been a big help for us.
And for you guys listening, what Larry's referring to is the book you wrote. We're going on, 12, 13 years already, which is crazy to think about. and I read it as soon as it came out. It's called Colossal Failure of Common Sense. It's the book about the entire collapse of Lehman Brothers, told by a bond trader inside Lehman. That bond trader just happens to be my boy, Larry McDonald, right here. Great book, especially, Larry, there's a lot of new investors since COVID hit, opening up Robinhood accounts and stuff like that. Some of these guys and gals have no idea what the heck happened in 2008. And, if you want to get a good lesson, I think Larry's book is fantastic. Barry Ritholtz has a book called Bailout Nation, which was fantastic. David Faber wrote a quick, easy read called When the Roof Caved In, I think is what it's called. Awesome book. I read all three of those back to back to back. And it was just after the whole collapse. I think I read them in the summer of 2009, right? Does that date? Yeah, that sounds right. Yeah, summer 2009. So definitely check that out. So with that being said, Larry, all these new investors, they don't know what commodities are like. They don't know what these big industrial stocks doing well. They're used to FANG stocks and crypto and Tesla.
Yeah,
Tell the kids what it's all about, investing in emerging markets and growth, Aussie dollar. Like, this is a whole new world that you and I remember from back in the day, but it's been a minute.
Yeah, it goes in cycles. I mean, these Australian equities and some of these commodity plays, Rio Tinto, I mean, these stocks have been in 10-year bear markets. And I think you've often said, like, you just watch the producers at CNBC or any financial network, watch who they put on, and it tells you a lot about the trend. And for a long time, the younger people watching us right now wouldn't know anything about these global commodity reflation plays because they were just in deep bear markets. Nobody wanted to talk to the CEOs. No one wanted them as guests on their shows, even though 2006, 7, 8, 9, 10, 11, these CEOs from these companies were on Kramer's show every night. And it was just an amazing bull market in commodities. But it all comes down to, like, one thing is energy, right? So energy, you have a problem with global coal consumption. So there's 3 trillion people in India and China. You've got 3 billion people, right?
Seems like 3 trillion.
Not trillion, but I'm thinking trillions because of the bond market. But you've got 3 billion people in India and China, and it's these economies are really addicted to coal, and they've been cheating on the Paris Climate Accord. That's kind of getting out there now, and so sectors like uranium, nuclear power. You now see Michael Burry talking this up. You're seeing Bill Gates. Literally the entire uranium space is probably 1/10 the value of Elon Musk himself. So you're talking about a sector that used to be very large, very well owned, and now because of that 10-year bear market in commodities, uranium, nuclear power, is very, very unloved. And there's an ETF, URA, but younger people, I'm telling you right now, over the next 10 years, you're going to see 200-300% more nuclear power plants on the planet. It burns 24/7. There's no shutdowns. And above all, it's really the greenest technology, the greenest power out there, next to probably hydrogen, but there's nuclear power is way ahead of hydrogen, and you're starting to see a big lobby in Washington. Bill Gates is behind this. I expect Buffett to make a move in the space at some point. But
Buffett uranium.
Well, yeah, you'll see some big players come in. I mean, you're already starting to see just the flows, and you mentioned the CCJ ETF, Cameco. That's the biggest market cap equity in there, but I think I'm just starting to see, like in the chat, we're seeing big value players that are now in this space, and it's getting more and more recognition. But on the oil space, the servicing companies, the OIH, these companies we're going to have a 3 to 4 million barrels a day shortage about a year from now. And if you just look at the amount of CapEx that's been taken out of the system, you look at Exxon, what they said last night in terms of their reserves. If we have a snapback in demand that's driven by this We've got the J&J vaccine, which had emergency authorization on February 4th. It normally should have been turned around by now if you look at the path of the previous vaccines, Moderna and Pfizer, but it's been delayed about 3, 4, 5 weeks. Probably in the next 2-3 weeks, that J&J, it's a one shot. It's a real game changer for travel, and it's a game changer for the United States because clients that I respect that are close to the industry, the medical field, they tell me that the J&J vaccine will be able to be distributed through 6,000 to 7,000 Walgreens and CVS's. So that's going to get you a big growth spurt in travel spurt through the summer and the fall. And we're going to have an oil crisis. We could have a year from today, and I'll make a prediction as we made the last time on the show, but we could have some rationing, some oil shortages in the United States a year from today in the first quarter of 2022. And so if that's the case, then your oil service companies that are still down, 50, 60, 70, sometimes 80% from the highs, that whole market's going to get a bid because exploration, capital investment is going to have to come back. 10 years from now, you can make a bear case for oil, but the bridge, the fossil bridge to the green meadow is a lot longer than people think. And that's why you need to start thinking about uranium and some of these oil service names.
Just sounds like all this energy, all these natural resources just screams Aussie, screams CAD, right? And you're seeing strength in those currencies, and dollar just hanging out near lows. And, it's funny, we've been joking lately that, people like to talk about the dollar because it makes them sound smart, right? So, but the reality of the matter is, the dollar weakness has coincided with risk appetite or lack thereof over the years, right? Remember, the dollar started getting crushed in the fall of 2016 when stocks started ripping. The dollar bottomed out in January of 2018 when stocks all over the world started falling apart. The dollar peaked last March when the stock market started to rally. And now here we are, stocks continue to press up against new highs, not just in the United States, but all over the world, and the dollar's near lows. So do we need that dollar to continue lower for this commodity, everything we're talking about, energy, basic material, all these things going higher and stocks in general continuing higher as well? We need that weaker dollar?
We do, and the Fed needs it weaker because the Fed is, to your point, you just made some very good points. And if you read between the lines, what you just talked about, every time that dollar surged, we had a real ugly surge in inequality in the United States, right? So your dollar surges led to global weakness that fed back into the U.S. We had a number of sell-offs in U.S. jobs left the U.S. Hundreds of thousands of jobs in 2016 left the United States as we headed toward the election because of that strong dollar in 2014-15. So the Fed knows that if they contain the dollar, the global economy, remember, there's call it 18, 19, 20 trillion of GDP in the United States, 20 trillion, and there's 65, almost 70 trillion outside. So what happens is when you have vaccines that come into the picture and you have a weaker dollar, remember that 65 trillion of GDP is dramatically impacted by the vaccines and the weaker dollar. So it's a double whammy positive. And
why is it impacted by the vaccines?
Well, because there's so much GDP outside the United States if you have the vaccines that are deployed all around the world, that 65 trillion is going to really respond well to vaccines, because in a world with COVID, there was such a flight to quality where everybody had to hide out in the dollar. Whereas with vaccines, to your point, it opens up market with that weaker dollar, and then in the vaccines, it opens up strength in the global economy that feeds into commodities, that feeds into the Aussie dollar. And so when you deploy vaccines around the world, because it's being deployed, the $65 trillion of GDP outside the United States benefits a lot. In other words, it juices that part of the economy, and that drives assets, that drives demand for other currencies, and it creates a flight out of quality, a flight out of the United States.
Now, which currencies in particular? Is it all of them, or is it specific? Because like when you look at emerging market currencies, they've been doing well, right? They look a lot like these energy stocks, right? CAD and Aussie doing well. But then you also have the euro, which represents what, like 60% of the dollar index or something. So the euro is also doing well. So is it these developed market currencies? Is it the EM currencies, or is it the whole slew of them?
Well, that's a great point. The euro is such a big trading partner with the rest of the world. Germany is such a big exporter that what's strange is there's a point where when the euro moves higher, it actually it's actually a good thing. If the euro moves too high, it's bad for Europe. But if the euro moves higher, it's because that they're really the global economy is strengthening and it's helping the European economy. And so as long as the dollar, as long as the euro doesn't strengthen too far, too fast, at some point it would hurt the European economy. But it's really about commodity producing countries like Chile. Chile's the largest copper producer. The ECH ETF, we've been long that since the summer. And then EWZ, Brazil's a big commodity producer, like you said. Aussie's the king commodity currency of them all. So yeah, you want to watch these currencies because as long as the Aussie dollar is a great indicator right now for global growth. Because and I commend you for keeping an eye on it, because that's going to be your ultimate tell as to how sustainable this commodity rally is. If the Aussie dollar doesn't act well, it tells you that the commodity run is kind of run its course.
And even more so, Aussie yen. Is that like Aussie dollar on steroids, basically?
Yeah, Aussie yen. Well, Japan's economy is growing at probably the fastest pace in the last several years. But at the end of the day, yes, remember the two flight to quality currencies in the world when there's problems are the yen and the dollar. And those are like the two safe havens. So when the rest of the world's doing better, that Aussie yen is a great indicator because it really speaks to a global reflation renaissance. Whereas that when the yen is strengthening, it's a sign of some problems. It's a pretty good like early warning sign indicators to watch the yen versus other currencies.
We touched on Europe, Larry. You're the bank guy. You talk to all these bank guys. What Deutsche Bank making new 52-week highs just doesn't strike me as something that happens when the whole world's about to fall apart.
Yeah, no. These banks in Europe have been dealing with negative rates and flat curves and like Brexit's trade wars. Brexit was just a huge. Right now that's why I still love the pound. I love the European equities like through the EWU, the UK equities, because you're just talking about 10 years of a really, really bad environment. And now Brexit is history. You're going to have a major infrastructure plan coming out of the United Kingdom and Boris Johnson. And Europe the same way. I mean, Europe is like looking at the United States and our fiscal plan, and they're like this move by Draghi is unbelievable. I mean, what Draghi has done in like 2 months essentially comes out of nowhere, is now running the biggest risk, the biggest fragmentation risk in Europe was Italy. And now you have Super Mario in charge over there, and he's done an amazing job so far at containing that. Over the last 5 years, we've had this risk from these Trump-like other politicians around the world, and Draghi has contained that fragmentation risk, and that fragmentation risk is just the risk of, say, Italy leaving the Eurozone. So yeah, so all of these things that have been hanging out there, think about, remember from Memorial Day 2018, there was a political crisis in Europe, and there was the Salvini Liga group. It looked like they were going to leave the European Union. So all of these things, Brexit, trade wars, COVIDs, EU fragmentation, have been really marginalized, and that's supporting the global economy. And that's going to take assets. There's just trillions of dollars. There's still 12 trillion bucks in tech, and in tech stocks are really designed for that previous last decade, that deflation, Brexit, trade wars, COVIDs. Now that money is going to flow around the world to both developed markets and emerging markets.
What I mean, you're just sort of saying the same thing that we're saying, seeing the same thing. Maybe you're a little more aggressive on the energy front than we've been, but I obviously don't disagree. I mean, we're in energy. You're just really optimistic on energy, which is interesting to hear. No, I guess no disagreements here. What is going to ruin the party, right? Like what you're seeing, I'm seeing Aussie dollar, weak yen, base metals, commodities, global growth, industrials, rotation into EM, all of these things. We're seeing the same thing. What's going to ruin that? Where are JC and Larry just completely wrong?
It's yields. So if yields move around the world, there's just too much debt. So if yields move too high, too fast, and we get out of control, and central banks have to try to step in, the first stage would be great for commodities, because if the Fed steps in with yield curve control, that'll be much weaker dollar, and that'll help the global economy. But around the world, if you have a substantial move up in yields, because you have that 110 trillion of bonds that were below 1.75%, and we've just now this year, according to some people I respect in the chat, say we've got anywhere between 4 to 6, maybe 7 trillion of losses because of rates move. So it's really rates. If rates move too fast higher, and central banks have to kind of, put out the party, then things are going to get ugly. But we're probably a ways from that. We're probably, that could happen, toward the end of the year. But there will be. Remember, there's two trades here. There's that trade we just talked about with global yields and eventually, ruining the party. But the party right now is being ruined for tech, because tech stocks are essentially zero coupon bonds, right? So when you're long a technology stock, you're long a long stream of cash flows, and software companies. These companies trade at a much higher multiple in a deflationary environment. When you move to an inflationary, reflationary world, these stocks should be, I remember Microsoft used to trade at 15 times earnings, and it was a great company. And now, even 10 times earnings, I think in 2011, 12. Well, 2011, you have much higher reflation. And so Microsoft was trading in a reflationary world. Microsoft was trading at 10, 11, 12 times earnings. And now, you're talking like 30 to 35 times earnings. So stocks like Microsoft have to wake up to this new reflationary world.
So in a weaker dollar environment, the types of things you think about are base metals, right? Inflationary trades, emerging markets, but hard to have a conversation about a weaker dollar without talking about gold. Are we finally going to break out of this decade-long nothing?
Yeah, well, gold is suffering now because real yield, the 30-year real yield on the 30-year bond has gone from negative 45 to plus 9 over the last 3, 4, 5 months. So negative 45. This is negative real yield on the U.S. 30-year bond. So it takes inflation. All that means to our viewers is the yield on the bond against inflation expectations.
CPI.
So what happens is, as the yield goes up faster than inflation expectations, the real yield goes higher. So you went from minus 45 basis points to plus 9 basis points over the last 4 months. And that's not good for gold. Gold needs, when you're trading gold, you're really trading bonds, and gold needs real yields to be moving the other way. And that's why you've been pounding away on gold for the last couple of months and negative, and you've been right, because you probably must have smelled out this whole real yield problem.
Mostly the trend itself. It was breaking down relative to other commodities, breaking down relative to stocks. It was more the relative weakness that caught my attention, more so than the real yields, for sure.
Yes, and it was really a crowded. It's like this with all cycles. What happens with a commodity cycle? The first stage, everyone piles into gold, and then comes your copper, then your oil, and then the last stage of it will be your uranium and uranium and coal and the ags picked up through the summer. So it's like a stage, and you picked up brilliantly on that early stage of like a migration out of gold into other commodities. Gold was just way too crowded, and what gold needs to really answer the question is, if we go into yield curve control, if the Fed announces sometime, I think they will like June, maybe in the late early second quarter, they could come out with this yield curve control. And when they do that, they're going to basically say that's what Japan has done. The Aussies are doing it. Australian Central Bank, the RBA is doing it now. And they just come out and say, okay, we're going to cap 10 years at 1.6. And come, all you can eat, come one, come all. And when they do that, then your negative, then your real yields on long-term bonds will go massively negative because inflation expectations will continue to rise, but your yield is capped, and then gold would probably be up $1,000. But the way to play that is really, everybody looks at gold, but the silver miners, Hecla, the SIL.
What about platinum?
Oh, platinum.
Platinum's killing it.
Platinum's kicking gold. Platinum is kicking gold's ass. I mean, platinum, there's no supply. The relative supply of gold to platinum is like literally like 8 to 1. There's just in terms of global supply. And platinum, silver miners, that's where you get the biggest bang for your buck when they turn on yield curve control.
All right, Larry, last question. I'd be remiss if I did not. You and I haven't chatted in a while, so it hasn't come up since maybe last time we had dinner together. But what do you think of this crypto stuff? Is this for real? Is this, you bullish Bitcoin?
Well, I'm an old timer. I'm in my 50s now, but I just.
What does age have to do with being a bullish Bitcoin or not?
Well, I know. I just am a value person. I'd rather buy Bitcoin when it goes on sale. You've had 3 50%, you've had 5 50% drawdowns since 2016. It's just, you're gonna get another one. You got kids, these videos with these kids, these TikTok videos of these kids bragging about profits on crypto. It just smells to high heaven. And I wouldn't go as far as Charlie Munger, to call it rat poison, but because it's clearly moved into a whole new realm of fiat alternatives, right? So there's a valid point to that. But you want to buy this stuff, and I beg of anybody to listen, just wait for it to go on sale. You'll get them every single time. You will get a sale in Bitcoin, and it won't be 10, 20%. The next one's going to be like 50, 60%. It's just not liquid enough. I've got 2 or 3 friends that are in the space that I know really well. One of them's worth close to $1 billion. And his point is you try to move 10 or 20 million dollars of Bitcoin, and it's almost impossible. You try to move 10 or 20 million of dollars of gold, you can do it in 2 seconds, right? So it's just Bitcoin. The problem is when the whales want to move out, the minnows get destroyed, and all those drawdowns. What it does is those little kids or the young people in their 20s, 30s. They just haven't experienced markets like you have, and they will just every single time suffer at the hands of liquidity every single time. And they will. You just look at the volume of stocks or crypto. Look at the volume at the lows. They will get carted out. You can have the greatest long-term investment thesis in the world. I'm a long-term equity investor, long-term crypto. A 20, 30, 40% drawdown will cart the mob out every time. It's just the way markets work. And that's the unfortunate thing about it. So that's why I'm thinking if you want to buy those things, you want to wait for them to go on sale.
Okay, boomer. So I'm getting this pushback, and I argue with some of my smartest friends about it. And, they're telling me that the reason gold is struggling is because money's going into Bitcoin. And I'm just not buying that from obviously the strength in Bitcoin doesn't help gold because it's just another alternative to fiat, like you mentioned. But at what point, all the cryptocurrencies could go to zero tomorrow. It's not going to have any impact on the global economy. At what point is there systemic risk in crypto? At what market cap or something, right? Is there a level?
Well, right now we're at $1 trillion, maybe $1.2 trillion if you count all the crypto, mini cryptos. And then you have another 700, 800 billion in Tesla. So you've got 2 trillion in Tesla and Bitcoin. Just think about the idiocy of that. $2 trillion in Tesla of world wealth is in Bitcoin and Tesla. I mean, that's just mind-boggling insanity. And so you bring up a good point, because it's when you have like the market cap of some of these stocks, MicroStrategy, for example, Tesla, when you're like, it's one thing if Bitcoin is at a low price point, but when Bitcoin's at a high price point, the market cap moves are so much greater. So I think we're near a breaking point because you've got so much market cap, 2 trillion. Think about 2 trillion of market cap is in crypto and Tesla today. And 2 years ago, that number was probably 300 billion. So you have an extra, you have an extra 1.7 trillion of money, of capital that's in this space. So, but the space is still volatile, right? The volatility is still there. So your capital destruction on these moves gets bigger and bigger and bigger, and it creates, it's not systemic risk, but it definitely leaks over to other parts of the market. You can see over the last couple of weeks when crypto moved lower, tech stocks moved lower, even cannabis, fuel cells. So all these crazy, growth sectors trade together, and that's what you have to watch out for. Is it's a much bigger sandbox than it was 18 months ago.
Yeah, but these are little these are little trickles. They're not real earthquakes. What market cap do the earthquakes start?
Oh, I guarantee there's nobody that knows that. It's like you could ask Elon Musk, you could ask David Einhorn.
Somebody who knows it, I feel like you would be close to be that.
Thank you.
If I'm going to ask somebody, it's going to be you. Like, compare it to bonds, compare it to equity market cap. Like, where does it start becoming a potential issue? 10 times the current? 5 times?
I think 2 to 3 trillion is a lot. I just think you can't have $2 to $3 trillion of, think of biotech stocks, right? The amount of money that's in biotech stocks have historically had incredible volatility. And it's okay because there's not $3 trillion in biotech. But when you have like the biotech stock volatility that's in a $3 trillion asset class, or right now it's probably 2.2. It's somewhere between 2 to 2.2, I think. I think we're somewhere between 2 to 3 trillion. It's just too much, and eventually the market's going to be able to handle this. But when there's less volatility, but as those markets mature, there's just too much volatility. So I would say 2 to 3 trillion is really table max. Well, but where it starts to really leak over to other asset classes, it's just too much wealth destruction.
So interesting, Larry. This conversation is so fun. We could do this forever. I gotta hop. Why don't you tell the folks where they can find you? Where can they read your research? Where do you find Larry?
Well, it's mainly institutional investors. We have a live Bloomberg chat. BearTrapsReport.com is the website. I'm at ConvertBond on Twitter. We are opening up what's called the Turning Point for retail. It's like a retail product at a lower price point, and that's rolling out this year. And so, they can come to our website, the BearTrapsReport.com, or just look on Twitter at ConvertBond.
Love it. And go get Larry's book, Colossal Failure, Common Sense. Great book.
Thanks. And I tell my wife once a month, as a former Lehman trader, if we sell 1 million books, we'll break even on our Lehman stock. So
is that all?
Buy one. It's the best book in the world for young kids. So go out and buy one.
I agree. Gives you good perspective. All right, Larry. Go enjoy Panama.
Thanks, my friend.
Hey guys, thanks for listening. For more on what's happening in bonds and how it's affecting the stock market, go check out what the team is talking about. You can find it all at allstarcharts.com. See you next time.